Hello everyone, myself CA Shantanu Salawane, and I have with me my colleague C Aditya Gade. We are from ESOP Direct, a Capita company. So I could see there are sufficient number of people. We can start, I guess. Yes. So a brief about ourselves or our firm, ESOP Direct. So it's a company which guides you or which assists you, which takes care of you throughout your ESOP journey. The company helps its clients for managing for end-to-end management of its ESOP. We assist our clients to plan to design their ESOP schemes, to handhold them during the ESOP grant procedures, assist them to maintain their ESOP related data on our platforms, help them during the valuation as accounting requirements, and also we takes care of the exercise process. So today we are discussing on the crucial part of cost management of the ESOP, which is crucial part comparing the considering the coming year and the huge cost involved.
Sorry to disturb you. Can you put the PPT on presentation mode?
Yes. So we'll touch upon the cost part of the ESOP plan. So we have, I shall share my screen. Yes. Is everyone able to see my screen?
Yes, but
Aditya?
it's not on presentation mode. Presentation. Yeah, it is now. Yes, it is.
Yes. So to start with, we'll touch upon these areas, these key concepts of the ESOP cost, wherein we'll try to understand what is ESOP, why the ESOPs are issued, and how we should account for the cost of ESOP. What are the methods there are available in the Indias, how to compute the fair value, how to compute the intrinsic value, what are the normal challenges normally our clients face, how do we tackle them, how do we assist our clients, or then there are certain disclosure requirements in the Indias which we'll need to follow. There are certain information disclosure has to be there in the annual reports. So first we'll try to understand what is ESOP. So ESOP basically is a scheme wherein the company is giving a share in equity to its employees for fulfilling certain vesting conditions. So earlier there were criteria wherein the companies which has been there for a longer time or had shown their loyalty towards the company by working in the same entity for, let's say, 10 years, 15 years, 20 years. So earlier the trend was to appreciate their loyalty and appreciate their efforts. But nowadays, since there has been increasing trend in startup industries wherein the ESOP bearing its catchy nature are becoming part of the compensation structure itself. So wherein now the company, while granting or while deciding the compensation structures itself, allot ESOPs to the company, allot ESOPs to its employees, or to attract the fresh client, or to attract the fresh talent from the pool. Normally, if we see the general objectives of granting any ESOP was to reward performance or reward loyalty or enhance retention. The new objectives has been there to attract the new talent or to attract the new people from the pool, wherein apart over and above the fixed compensation, your ESOPs also help to have a skin in the game, or to make you feel of or a sense of ownership in the company where you are working at. So next we'll go to understand the ESOP cost. So we are talking about the ESOP, its intangible nature, its value to the employee, its need to reward the client, or to need to appreciate the employee. But from a company perspective, we'll try to understand, is there any cost associated with the ESOP? So if we see, there are standards prescribed for companies who have to follow Ind AS. So Ind AS 102 provides for the requirement to recognize the cost associated with the ESOPs, and guidance note, which is issued by the ICI, also provides similar information or similar guidance on the recognizing the cost associated with the ESOP. So there has been two approaches which the guidance note prescribes. One is fair value approach and another is intrinsic value approach. But for Ind AS 102, which deals with the share-based payments, it strictly allows it strictly asks the companies to follow fair value approach. So the difference between the fair value approach and the intrinsic value approach, we will discuss it in next couple of slides. But from a company perspective, we'll have to understand that ESOP is a derivative. So it gives a right to it gives a right to one party, and also brings an obligation towards the other party. So on fulfilling the vesting conditions, an employee will have the right to exercise their options and convert those options into shares, and the company will have to oblige to its promise to convert the options into shares. So that so considering the nature of ESOP, we can term it as a derivative, and the derivative will have some value attached to it as on the date of grant. So about the cost terminology and the date of grants, etc., we'll try to understand with the help of this example. So this is general life cycle of an option. To start with, let's say company ABC decides to grant Aditya certain number of grants. The company will fulfill its the company will fulfill its requirement by conducting board meeting, shareholders meeting, taking necessary approvals from its authorities, and will make an offer to Aditya, and along with 20 other employees. These employees will be given a time period to accept that to accept that offer. Once the company and employee accept that offer mutually, then we can consider that options has been granted. As per Ind AS 102, the definition has been given that we can consider options has been granted only and when the employee as well as the company accept the terms and conditions. So if we see the bracket which you have mentioned here, my cost recognition start from grant date till it has to be booked till the vesting date. So considering or determination of grant date becomes very critical, because my fair value has to be as on the grant date. Since my fair value is attached to the grant date value or the parameters as on the grant date, it becomes very critical to decide grant date. So to give you an example, there was a case in our instance where a listed company was experiencing a turmoil in their share price within, let's say, in 3 trading weeks, there was very much a fluctuation in the share price. So due to which it had a direct impact on their fair value, which resulted higher cost for their ESOP plans, which were granted during that time period. But in the next month, or let's say in the previous month, the share movement was pretty natural, or pretty, I would say, lenient compared to other months as well. So due to which their fair value or their ESOP cost associated with the options was on a similar line or on a linear basis. So while deciding the grant date, it becomes very critical to make these things in mind, that my grant date, my share price, if it's a listed company, my share price as on the grant date will have a direct impact on my fair value. Or let's say in negative manner, if the share are going downwards, then it will have a negative impact on the fair value. Okay, then coming towards the next point, vesting date. So vesting date is the date as on the vesting conditions has to be fulfilled. Either it can be time conditions, or it can be performance condition. That is, the employee has to perform in a certain company for a certain period of time, or it can perform to achieve certain targets given to them. My cost has to be amortized from the period from grant date till vesting date. So let's say for a grant which was made on 1st of April, there can be 3 vests. Let's say 1st of April 25, 1st of April 26, and 1st of April 27. Now there, the option granted as on 1st of April 24, let's say these are 100 options. So vesting date and vesting schedule, let's say out of 100 options, my 35 options shall vest on 1st of April 25. 35 will vest on 1st of April 26, and remaining 30 will vest on April 27. In another example, if I'm keeping vesting date as 1st of April 25, 1st of October 25, and let's say 1st of April 26. So in this case, I'm keeping more than one vest in 1 year, since the index prescribes minimum 1 year of vesting time requirement. My first vest has to be after 1 year of the date of grant. My subsequent vests can be as on any date. That doesn't become an issue. But my vesting structure will have an impact on my cost amortization as well. So let's say in first example, wherein I have 3 vests on a yearly basis, my cost will be amortized within 3 years. However, in the second example, where I have kept my 2 vests in second year 2, and last vest on year 3, then in that case, my cost amortization shall also vary. So it becomes very critical to understand before granting options, to understand how much cost effect would be there if you keep the vesting schedule in a certain way, or to understand how much how much expense shall be booked towards profit and loss statement. Accordingly, basis on the other budget forecast, we can decide the vesting schedule as well. Then going forward, once the employees fulfill my vesting conditions, then my options are converted in the employee shall exercise his option, and the exercise option shall be converted into shares. In the year of exercise, as per income tax, the cost amortized in the profit and loss statement during the period from grant date to vesting date is not allowable. It's not an allowable expenditure. However, it becomes allowable expenditure in the year of exercise of options. So it becomes very critical. Along with my vesting schedule, I also keep the exercise period as per my budgets. Because in the year of exercise, my employees shall be taxable for the perquisites they have received against exercise of options. Against that perquisites, I can claim an allowable expenditure in my profit and loss statement in my income tax computation of income. So my exercise, So my exercise of options becomes also very critical. So these 3 points, my determination of my grant date, setting up my vesting schedule, and also defining my exercise term is very important before grant to plan your ESOP cost amortization. So the further points about the approaches and the challenges which we face about the cost accounting, my colleague Aditya will take over. Aditya?
Yes, thank you, Shantanu, for that, and also thank you very much for the options being granted to me. So we'll start with approaches. So as we understand that we have to do some kind of cost recognition, and for that cost recognition, there are 2 approaches specified in guidance note as well as Ind AS. Guidance note, by that I mean, is accounting standard, and Ind AS is Ind AS. So there are 2 approaches in guidance note. They have mentioned specifically that you can either follow uh, intrinsic value method or fair value method. So we'll try to understand more on what are these approaches. So first we'll start with intrinsic value and what are problems related to it. So as I've mentioned in the PPT, that formula for calculating intrinsic value is just a plain formula: market price of the share minus exercise price per option. So let's say in the previous example, I have given 100 options. Each option for that one share is convertible by each option. So one share is valued at 100 rupees as on grant date, let's say, and the exercise price of that option is also 100 rupees. So as per intrinsic value, the cost to be recognized in the books is 0 because 100 minus 100 is 0. But the problem in this case is there is only one factor considered, that is intrinsic value, and another time value factor is not considered. By time value factor, what I mean is in fair value of fair market value of the share, we take it at 100 rupees. But for calculating a fair value, we would need the present value of what the share price would be as on the date of exercise. So let's say I've given granted one option at 100 rupees, and as on exercise date, the price jumps up to 200 rupees. But we need the present value of that 200 rupees as of granted. But intrinsic value doesn't consider that. Apart from that, there is another factor known as dividend factor. So let's say I have a option at 100 rupees exercise price, and company declares dividend of 10 rupees per share. Let's say it is 1% of the 10% of the fair value, face value. So that 10 rupees dividend I won't be getting, but a person who holds equity share would be getting. And due to declaring of dividend, there would be a fall in market price by 10 rupees theoretically. There might be some other number of fall, but there would definitely be a fall in the share price. To compensate for that, we have to adjust that 10 rupees if any dividend will be given over the period. It is an estimation. We can't say that there would be a fixed number of dividend over the period. Management might decide that they will increase the dividend or not declare a dividend at all. The second part of the intrinsic value is the exercise price. Here as well, the exercise price we are considering 100 rupees in my case as of today. But we won't, as a company, we won't be getting the exercise price as of today. We will be getting it as of the exercise date. So we have to PV that as of today, and it would definitely be lower than 100. So these two factors are not considered in the intrinsic value. That is the main reason we feel that fair value is better than intrinsic value. As Shantanu explained previously, that there is Ind AS specifically asks you to follow fair value method. There is a case if we are not able to do fair valuation, then we can use intrinsic valuation in Ind AS as well. But we have done thousands of fair values as of today as a company for hundreds of clients, and we have never faced a situation where we were not able to calculate the fair value. So we can confidently say that it is in substance mandatory to use fair value in Ind AS 102. So moving forward, we understood what are the problems with intrinsic value. One is the only problem is they don't consider the time value factor. In fair value, let's take a method, Black-Scholes. We can take any method. They are similar to Black-Scholes as well. In that, we consider the intrinsic value factor, that is market price minus exercise price. Just one change in these two prices is that we take PV of share price as of exercise date. And second is for exercise price, we take PV of that particular exercise price. In our case, it was 100 rupees. So we PV it as of granted. Just for clarification, in India, we are not allowed to issue any option for which exercise price is lower than face value. It is restricted in India that we can issue a share lower than a face value. Shantanu, can you go on the next slide, please? Yeah. So we'll understand a bit more on what does Ind AS 102 covers. So it is not specifically covering the employee benefit expense only. It covers all share-based payment expenses. For example, I am a merchant selling machinery and a company wants to buy machinery from me. So instead of paying me in cash, they pay me in shares of that particular company. That also case is covered under 102. But our topic of discussion is mainly for ESOPs. For ESOPs, there is a plain arrangement. Let's say I am the employee in ABC Limited, as Shantanu started the example. I am an employee. I have been given 100 options for my services to the entity. So it is kind of barter transaction, even though I am paying an exercise price, but I am paying a discounted price because we are expecting that share price would increase over a period of time. I don't think there would be any company in which the company is expecting that their price would fall in a long term. So as I mentioned that Ind AS 102 covers all the share-based payment, but our topic of discussion is just ESOPs, that employee share-based payment. So the next point is for each goods and services received. In our case, only services being received from the employee has to be recorded in the books. For that recognition, we have to do fair valuation of that options. Generally in Ind AS, the rule is every incoming thing, may it be goods or services, should be valued and recorded. But for this 102, there is a specific exception to it, that we will be valuing the outgoing thing, that is shares of our entity. Generally, what is the scenario in the example that I gave earlier, that I am a vendor, I am giving a machine to the company and company is giving me shares. So my machinery would be valued and not the shares. But for ESOPs or employee share-based payment transactions, no, the service won't be valued. The options that are being given out by the company would be valued. This is a specific exemption. There is no other exemption exception to it in all the Ind AS. So moving forward, measurement of the consideration. So we'll understand when the measurement is being done. So we are talking about ESOP specifically, which would be settled in equity, as the name suggests, ESOP. So in ESOP or equity settled based cases, the valuation is to be done as of grant date. So that's why in the previous example as well, I took all the numbers as of grant date and not any other date. If these options are being settled in cash from the inception, it has been agreed to, then we have to value the options as of each reporting date, but that's a different topic to discuss. For this calculation, one of the most important thing is vesting schedule. As Shantanu explained in the earlier example, that let's say there is an yearly vesting, so it will drastically impact the fair value that we are calculating. So that is the most important thing. The further things that Shantanu has already covered, but I will reiterate it, is that the cost that we will be calculating would be recognized over the vesting period, that is from grant date to vesting period. Now, why from grant date to vesting period? The main reason for that is matching concept, which we have learned from, if we are a person of finance background, we have learned it in 11th standard, that whenever the cost is being booked or whenever we are getting that particular benefit, cost has to be booked over that period. In this case, let's say I'm an employee of ABC Limited, I have been granted 100 options that would be vesting after 2 years. So let's say on 1st April 24, I have been granted some 100 options, and that 100% options would be vesting on 31st March 26. So in this case, particularly as I am required to wait in the company for 2 years, I have to book that particular cost over those 2 years only. Let's say on 1st April 26 itself I resign, then in that case I will be getting the vested options. So the cost booked will be remain in the books only. One significant twist over here is that is specifically a point of discussion for all the entities which are implementing their plan, is what are these conditions. So mainly over 90% of the times the conditions are, you wait with us, like I am the company, you wait with us for 2 years, get your options vested, and you can exercise those. But in few cases, let's say I am CEO of ABC Limited. So the ABC, in ABC, A stand for Aditya. So I am the CEO of the company, and I have been given 100 options. Let's say the value of the options is in lakhs of rupees, so 100 would be sufficient. So 100 options, and the condition attached to it is that company's share price should double in, let's say, next 5 years. 5 would be too long. Let's say triple in next 5 years. So I am a CEO. I can control those things to a few extent, because main planning or management is in my hand, so I can influence that, but not actually control that. So these specific conditions are called market condition, because share price is not in the hand of a company or that particular employee. Yes, we can influence the profit, sales, but not the share price. So in that case, these conditions are called market-based performance conditions. So these market-based conditions are valued by different method. It is fair value only, just the method is different. named as Monte Carlo. It is a bit complicated as compared to Black-Scholes. I agree, Black-Scholes is also complicated for many of the people, but Monte Carlo is a bit more complicated to that. But this is the main crux of what Ind AS 102 suggests. Shantanu, can you please go to next slide? Yeah, thank you. We'll try to understand more about the methodologies. So we understood that there are two approaches. One is intrinsic value, that is a plain formula, market price minus exercise price. The second approach is fair value. In fair value, there are many methods that we can use. First and most used one is Black-Scholes. So in Black-Scholes, there are 6 conditions. Actually, the name is Black-Scholes and Morton. The Morton one considers the dividend factor, which I mentioned earlier. So instead of saying Black-Scholes, we can say BSM model. So that model considers 6 factors which influences the fair value. The first one being market price. As I suggested, as I told earlier, that there is an intrinsic factor and time value factor. So we'll first talk about intrinsic factor. First part of intrinsic factor is market price as of granted. Second part is exercise price of granted. This is the intrinsic factor. Now let's move on to the time value factor. So for time value, we would need when the options would get exercised. Now let's say I have given an option of 3 years and I have a exercise period of 5 years from the vesting date. So 1st April 24 is my grant date. 31st March 27 would be my vesting date. And after that, up to 31st March 32, I can exercise those options. But problem over here is that we don't know when the employee or I would exercise that option. I can exercise it as of 1st April 27 itself, which is 1 day after my vesting date, or I can exercise on last day of my expiry end date, which is 31st March 2032. Sorry. So in this case, what we do is we estimate a midpoint of those 2 dates. And we estimate that that is the expected life. So expected life is from grant date to the midpoint of vesting and expiry date. So that is the expected life. Now, why we have to do that? There is another way to do that is by using a binomial model, but it makes it a bit complicated. So just for simplicity purpose, and it won't affect the fair value materially. So considering the materiality factor as well, we ignore the American style of option and we just stick to European style. So in short, what is European option? European option has a fixed expiry date. You can't exercise it prior to the expiry date. But American options are you can exercise it whenever you want up to a expiry date. So I can exercise it earlier as well. Options granted to me are American style, but we convert it into European style just for the simplicity purpose. Yeah. So 3 things we covered: market price, exercise price, and expected life. Fourth thing is volatility. So as I told you earlier, the market price of the share, we have to estimate what the price would be on expiry date and then PV it to as of grant date. So in the example I gave previously, 100 rupees is the price as of today, but we are estimating using volatility. We estimate that after let's say 2 years or 3 years as of expected life end date, the price goes up to 200 rupees. Then we PV it down to the grant date and use it as a market price. So for estimating that future price, we need volatility. Significantly, you would say that how would you calculate a volatility of unlisted entity? For that, we consider a peer company because we can't do any other way. We would be needing some volatility basis. So we consider a peer company. A listed peer would be beneficial. The fifth thing we would be using is risk-free rate. So now why risk-free rate? For doing PV of the future share price and PV of the exercise price as of exercise date. We have to PV it as of granted because we are valuing the options as of granted. So we just PV it using risk-free rate. Why risk-free rate? Because if the employee would have not or the employee would have not opted for options being granted, he would have invested it in a risk-free rate. It is a standard basis of assumption that most of the investor use. So we will be using the same one. The last one is the dividend. So as the name suggests, Black-Scholes and Morton, the third person has introduced a dividend factor to it. As I mentioned earlier, that if I am an option holder, I won't be getting dividend. But if I am a shareholder, I would be getting a dividend. Dividend adversely impact the share price. So let's say theoretically, share price as of today is 100 rupees, and today in the evening company declares a dividend of 10 rupees. Tomorrow, theoretically, the price would be 90 rupees. It can be anything, but theoretically, it would be 90 rupees because company is losing 10 rupees as a cash outflow. So that's a plain mathematics. So to adjust that specific part, because I am an option holder, I won't be getting any dividend. To adjust that part, we will be using dividend yield. So for dividend yield, what we do is we use the latest dividend declare, and we estimate that same dividend would be declared over the period of expected. So that's a best assumption that we can do. If there are any assumptions coming from the entity as well, we can rely on that as well, but that should be reasonable. Yeah. Apart from Black-Scholes model, as I mentioned earlier, there is a binomial model. Just difference in Black-Scholes and binomial is that Black-Scholes values European style of options having a fixed expiry date. Like I mentioned, there is a midpoint of vesting and expiry end date. On that midpoint, options are being exercised. That is our main assumption. On that basis, we do the valuation. But in binomial model, we draw the trees for each price probability, and we estimate what the price would be on each price benchmark. So it is a bit complex as compared to Black-Scholes. But if we compare the fair values of both these models, there is less than 1% difference in those two. Generally, Black-Scholes model is a bit higher than binomial model, but there is no difference of more than 1%. So that's it about the valuation methods. Yeah, Shantanu, can you go to the next slide, please? Yeah. Okay. So next part is the challenges that we have faced during our during my small experience and collectively for the company's huge experience in valuation of options. So the most India specifically introduces complexities because it prescribes fair value instead of intrinsic value. If there was intrinsic value, most of the Indian entities would go with intrinsic value because it is easy to calculate and there is no much cost involved in calculations, because it might be costly for few entities, few small entities which don't follow AS, which do follow AS and which are smaller in size. So the complexity involved is mainly for fair value. Apart from that, there is a bit complexity on cost recognition, but as we discussed earlier, that recognition is over vesting period. Why? Because matching concern. The third complexity we face is what is to be disclosed to the ESOP. So if you refer to guidance note, which is issued by ICI for accounting standard following companies, or Ind AS for the Ind AS compliant companies, you would get a huge list of what all is to be disclosed in the books of accounts. So it might get confusing for few entities, and due to that, there won't be appropriate disclosures involved in this case. I would like to mention one example of an entity which Shantanu and I did collectively a few days back. And in that company, the complexity they faced was they didn't knew that there is a cost to be booked. So they had granted their options in somewhere 2019 third quarter, and from that till as of today, they have not recorded any cost in their books. Lucky for them is they are AS compliant companies, and there is an option of calculating the cost at intrinsic value, and as per intrinsic value, their cost was coming up very nominal, so they can take a hit. But this might happen. Let's say uh, company auditor or company itself were not aware of how the cost recognition or disclosures are to be, then there might be some repercussions to the company as well regarding inappropriately presenting the financials. So there can be complexities in that. Then, yeah, Shantanu, can you go to the next slide, please? Yeah, so talking a bit about disclosure specifically, because we covered the fair value and intrinsic value in the previous slides. Also, we covered how the cost would be recognized. So valuation is covered, accounting is covered. For third most important thing about ESOPs reporting is disclosures. So in disclosures, as I mentioned earlier, that either you refer guidance note or Ind AS, there is a huge list of things that we have to disclose, but sometimes it might get confusing. So I will try to read out a few of those things, but I would suggest if you want to read it more in detail, you can refer to those accounting standards. So first is the vesting conditions. So I will start from the top. From the top, first thing that company is to be disclosing is when the plan is adopted. So when the shareholders or NRC has approved that scheme or plan, that date is important. Second is what is the pool size. What I mean is the pool size is, let's say there are 100 shares overall in the company. Of that 100 share, company has allotted 10 shares, that is 10% of total shares to ESOP. So whenever in future company decides to grant options, they would be granting that options from that 10% of ESOP. So that is the main thing that we have to mention. The third thing we have to mention is how many options are granted, what are their grant date, what are their vesting conditions. As I mentioned earlier, the significant conditions are based on time, but in some cases there are market-based conditions everywhere. So in that case, we have to mention what are those vesting conditions. Then another thing is exercise price. So exercise price is disclosure. Why it is critical is that what would be the cash inflow for the company in future. Let's say exercise price in India, as I told earlier, that we can't issue options at 0 rupees exercise price. So let's say I issue or grant an option at 10 rupees, which is the face value of the entity. And in that case, the reader or user of the financial statement can understand what the cash inflow would be in future when the employees exercise the option. Let's say instead of 10 rupees, we issue or grant an option at 100 rupees, which is the current market price. So the inflow would increase in future. So that's why it is critical for the user of financial statement to understand that. The third is term of option. Why term of option is important for the user is they have to know when the option might get exercised. Not when will it get exercised, because we never know when it will get exercised, but when it might get exercised. So at that point of time, the voting right or voting share of the promoters or overall all the shareholders would fall by a few percent. For that specific purpose, it is important or critical for the users to understand when the options would get exercised. The fourth thing, it is just for the reporting purpose, as mentioned in India's, the weighted average exercise price of the options to understand how the range is of a exercise price. The second is the forfeiture. What they mean by forfeiture is that, let's say options are given out for 3 years, but at start of the option, like as of date of grant of options, there were 100 employees. As of date of vesting, there were only 80 employees left. So that 20% company can estimate. They can't estimate exactly, but they can estimate by to a few extent that how the options would get, how the option would get exercised based on how the employees are retained in the entity. Let's say lower the higher the turnover, lower the retention, lower would be the exercise of the options, lower would be the cost, lower would be the dilution. That is the fourth thing is how many options have already been exercised. So from that, the user might understand how the dilution of voting right would be in the coming years on the basis of exercise and outstanding, which options can vest or are vested and can be exercised. So these two includes the outstanding options. Then other important things are options granted during the year. So regarding option granted specifically, there is a specific requirement by the Indias or AS for that matter, is how many options are being granted to a particular employee, which in total is more than 1% of paid up capital. So let's take the previous example, 100 total number of shares, 10% is the pool. Let's say one option is granted to me. So I am that person who has been granted 1% of more of the total paid up share capital. So it's nothing that we are not allowed to do that. It's just that we need to disclose that with name. So we have to consider that as well, that name of that particular employee would be in the financial statements. The second important thing is, let's say I am a KMP, as I mentioned that I am a CEO. I'm CEO of ABC Limited. So let's say total options granted in the financial years are 100. Out of that, 10 were granted to me, which is more than 5% of the threshold limit given in the index. So if an employee or KMP specifically, not an employee, a KMP has been given an option more than 5% of total granted options during the year, that has to be specifically disclosed with name. So I am emphasizing on with name because there might be conflict on whether we should project or display a name of particular person, but it is prescribed in India, so we have to do that. And yeah, and one major thing that we have to disclose is what are the variables or what are the assumptions that we have considered in calculation of fair value. So let's say I have my ABC Limited is an unlisted entity. So I have considered a peer company, let's say XYZ, which is in similar or same business of ABC. So in that case, I have to mention which company I have taken it as a peer company. What is that volatility that I have considered in calculation of the fair value. So I have given one example. Other things like dividend yield, we are taking an estimate of that. Then risk-free rate, all that things we have to disclose it in the financial statement. Yeah. Shantanu, can you go on the next slide, please?
Yeah, we can,
Yeah.
If anyone have any questions, we will be happy to answer.
Yes. You can just put the questions in the chat box. We'll read that out and answer this.
What happens to ESOPs after expiry date? So whether vested ESOPs and unvested ESOPs. So you can address both.
Aditya?
Unvested.
Okay, so unvested ESOP. So okay, so in both cases. So let's say let's take an example that we took earlier. In my case, that I have been granted 100 ESOPs, which would be vesting after 3 years. So I am taking the vested ESOPs which are not exercised and expired in that case. So in vested case, let's say in as of 31st December 27, my options are being vested and I have 5 years to exercise, but I don't exercise. So once the expiry period ends, I don't have any options to exercise that options. So I have no right to exercise that. And I can't do anything about that. About unvested. So in time-based, there can't be a case that unvested ESOPs are being expired. So I'll take another example of performance-based or market-based. Let's say in the example given earlier that I am the CEO of ABC Limited. I have been granted 100 options with a vesting condition that my share price or my company's ABC Limited share price triples in next 5 years. But we understand that in next 5 years, the price is still, let's say 150 or 200 rupees only. It's not near to 300. So in that case, the unvested ESOPs get cancelled and are like the treatment of it would be the same, that I won't have any right to exercise those options. So if we talk about the accounting treatment of those two cases, the vested ones, they are transferred to general reserve instead of reversing the cost, because the options are vested. We have got the benefit of employee service for that particular options, and still that employee has not exercised. So instead of reversing the cost, we just transfer it to general reserve. About the unvested ones, I have taken actually a significant example or specific example in which we can't reverse the cost. We can just put it in general reserve. But let's say it is not a market-based condition, some another condition in which options are not vested but expired. But in that case as well, in that particular case, we have to reverse the cost and not transfer it to general reserve. So it would be credit to P&L instead of credit to general reserve.
So like
I hope
in
that
case of separated employee.
Sorry?
So in case of separated employee, when there are unvested options,
Yeah,
that will
okay.
be
So
reversed.
okay, got it. So going back to the first example that I am an employee of ABC Limited, I have granted 100 options vesting after 3 years. So let's say in 1.5 year, I decide to resign. So after 1.5 year, the cost which I have booked for that 1.5 year would be reversed because we have not got the whole benefit of that 3 years of service. So for that case, there won't be any costs. So we have to reverse that particular cost.
Okay. I hope the query is resolved. Any more queries? Okay, Aditya, Shantanu, thank you.
Okay.
Let's
Yes.
wrap
Thank
this up.
you. Yes.
Thank you.
Thank
Thank you
you.
very much,
Thank you.
everyone.